Hello everyone, welcome to today's US Open live webinar. I'm your host Nikos Tsabouras, Senior Market Specialist at FXCM. It has been a relatively slow start to the week. It is of course Tuesday, July 25th at our usual time, 10 minutes before Wall Street opens. China stimulus stock is in the spotlight, but things are about to heat up as we expect policy decisions by major central banks and big tech earnings. That's what we will be discussing today, but as always, please read carefully through the risk warnings and the disclaimers, and then we will get started. Okay, let's get the ball rolling. Let's go straight to Euro USD. We're gonna start with that as usual. Then we're gonna talk also about the Japanese yen versus the dollar. We're gonna move to US oil and talk also a little bit about the China stimulus that we already referenced. And then, of course, we're going to go to NAS 100, the tech-heavy index, and then we're going to move to what's ahead and talk about central banks and key earnings that are coming up. So Euro USD continues its post-2023 highs pullback ahead of the policy meetings by the Fed and the ECB. Since hikes by both are priced in, it's what happens next that matters. Typically, we've seen a more hawkish ECB this year, but Monday's poor European PMIs create more fears around the European economy, and also today's lending survey by the ECB showed further tightening in the credit conditions in the second quarter, and that's creates pressure for a less aggressive stance by the Fed moving forward. It creates some dovish pressure, let's say. On the Fed front, January rate cut bets have been pared back, so an overly dovish market view has sort of moderated a little bit, but still markets see the upcoming decision as one and done. Now, in terms of the technicals, the EMA 200 is now at risk at around 1.1, and daily close below it would pose the upside momentum and expose it to the 1.086, 1.077 confluence of supports. The correction, however, is oversold, as we can see on the bottom of the chart from the RSI. So there are chances of containment around current levels, and above the EMA 200, the common currency is at the driver's seat and has the ability to push again for fresh 2023 highs at 1.1276, but a catalyst would be needed for that. Further progress, of course, will depend on the policy outlook differential. Let's go to the Japanese yen, to the US dollar versus the Japanese yen. It is cautious this week as markets brace for the policy decisions by the Fed and the BOJ, with high uncertainty around the latter. Although inflation is off its peaks, it ticked up to 3.3% core inflation ex-fresh food in June, according to the recent release. There are expectations for an update in the inflation forecast and a change in the yield curve control. There are some expectations, some market expectations about that. But Governor government data has largely put cold water on such hopes, and the Reuters poll showed that majority of participants don't anticipate such an outcome either. But the bank has surprised before, so it's all gonna come down to that. The bear has rebounded above the 200 period EMA, and the September 2022 intervention highs are back in the spotlight at 145.90, but strong catalysts would be needed for the greenback to breach that level. Now, the Fed, on the other hand, is approaching the end of the road in terms of tightening, whereas the BOJ would begin to normalize at some point. So there is scope for renewed pressure, although the downside appears well protected, starting with the thick daily Ichimoku cloud at around 140 and a little lower. Now let's shift gears and go to US oil. So China's recovery has lost momentum based on continued poor data over recent months. Authorities have taken various measures to support the economy, like the central bank's rate cuts. And of course, yesterday, the Politburo pledged to step up its efforts to address the difficulties. Expanding domestic demand, sparing private investment, and optimizing property policies are some of the stated intentions, according to what we've seen in state media. Now, the IMF earlier today maintained its 5.2% 2023 growth forecast for China, but sees signs that the recovery is losing steam. Of course, China is the world's second largest economy and the biggest importer of oil. Now, the news around the pledge from Chinese authorities to support the economy helped US oil yesterday to enter its fifth straight profitable week. And that brings the 2023 highs in the spotlight at 83.55. But we are cautious around sustained strength past that level. On the other hand, these intentions are just intentions. We don't know, they're not actually actual policies, actual measures. And the international agency has revised down its 2023 demand forecast for the first time this year. And although it is expected to be a boost in demand in the second half, it is still likely that we're going to have a roughly balanced oil market. So there's definitely a risk, downside risk still here, and we're already seeing that US oil is pressured today after yesterday's boost. So there is a risk of a return towards the 200 period EMA at around 73.5, but strong catalyst would be required for further losses. And with 1 minute before Wall Street opens, let's go to the tech-heavy index, the Nasdaq. So Nasdaq 100 is somewhat subdued today after a losing week, as markets reacted negatively to the quarterly results of Tesla and Netflix. And the next leg of the moves will be determined by the Fed, the outcome of the Fed and big tech results. We're going to talk about both these things in a little bit. Now, after the losing week, this pullback that we saw there exposes the index to the 200 period EMA at around 16,100, but strong catalyst would be required for daily closes below it, and the downside is well protected in any case. Bulls are definitely in control at this stage and can tackle the 16K mark, but the all-time highs still look distant at 16,770. So that's pretty much it on the technical. So now let's see what's ahead. It's central banks and earnings that dominate the week. The Fed is due on Wednesday. 25 bps hike is priced in, so focus shifts on what's next, but the outlook is very uncertain. The Fed's projections imply another hike past July, but markets view it as one and done. The last CPI inflation report showed steep deceleration in inflation, and it's likely that policymakers have already done enough given the lagging nature of tightening, but the labor market is still very strong, calling for a sustained restrictive stance. Overall, I think it will be hard for the Fed to declare a victory on inflation, and it's likely going to be cagey around the next step, especially since there is more than a month until the next decision in mid-September. The next one after tomorrow's, of course. Now, the ECB picks up the baton on Thursday, also widely expected to hike by 25 basis points. So the important thing is what they may signal in the next meeting. There is some speculation, some growing expectations that it will become less aggressive and maybe even pause given fears around the economy based on recent data. But President Lagarde has largely been hawkish because policymakers are not satisfied with inflation and its outlook. Headline has been coming down, but is still far from target, and core actually ticked up in June. Of course, there are some other things in terms of economic releases, such as the Q2 CPI report from Australia on Wednesday. That's how the day starts. Inflation has been easing in Australia over the last few quarters, and the RBA believes it has peaked. It paused again earlier this month, but kept the door open to more hikes as inflation is still far from the 2% target, 2 to 3% target. And now let's round things off with the earnings, the upcoming earnings. The Magnificent Seven is in the spotlight. Tesla kicked things off for the group last week, and now focus shifts to Alphabet and Microsoft tonight in another round of the AI battles. Microsoft has the first mover advantage. Google is picking up after an initial slow start, but has some catching up to do. Meta Platforms follows on Wednesday. It is having a great year, cutting costs, placing a renewed attention to artificial intelligence, and launching a new platform to rival Twitter. So can it carry on the momentum? We're gonna find out on Wednesday. So that's pretty much it from me for today. Thank you for joining me. We will talk again on Thursday at our usual slot, 10 minutes before Wall Street opens. Thank you for joining me.